Welcome to the Ellsworth Advisors update. I'm Kelly Keenan. This is Cameron Mealy. We're the managing directors at Ellsworth Advisors. Today we're going to review economic numbers for August, some of the projections going forward on the economy, and then also discuss how that affected our portfolios, where they're at year to date for the month, and then kind of our thoughts going forward. Cam, why don't you kick it off with an economic recap?
Thank you, Kelly. Since our last video, there's really been two major pieces of economic news that have come out. Number one, Fed tapering. Number two, the August jobs report. So anybody who's been watching our videos will remember that we looked at a first quarter with above 6% GDP growth, a second quarter with above 6% GDP growth, and during our last video, the outlook for the third quarter was very strong GDP growth. All of this has really, brought forward the idea of tapering. Tapering being the Fed starting to slow down their purchases of bonds. You will remember on March 15th, 2020, the Fed cut short-term interest rates to zero and restarted its large-scale asset purchase program, more commonly known as quantitative easing. Currently, the Fed's buying $80 billion of Treasury securities and $40 billion of agency mortgage-backed securities each month. Why that's important is when the Fed buys bonds, they reduce the supply of bonds in the market, which means that investors that are looking for government securities bid those securities up, which conversely brings down the interest rate. So the Fed is manipulating the interest rate, holding interest rates close to zero, and when interest rates are low, companies borrow money to invest in their businesses, consumers borrow money to buy new houses, to renovate their houses, to go on trips, to buy cars. The Fed is basically providing stimulus to the economy in the form of monetary easing. Now, there's been a lot of talk recently that the Fed has gone far enough. They need to begin tapering, which means not necessarily stopping buying bonds, but really reducing the amount of bonds they're buying per month. I saw today Goldman Sachs thought that when tapering starts later this year, it'll be about $15 billion less each month as they reduce the taper amount to more of a target rate. The other way the Fed controls interest rates is through the federal funds rate. The Fed funds rate is at zero right now. That's the rate that banks borrow from the Fed to meet their reserve currency obligations. So essentially we have a Fed holding rates low, but low rates, as we've talked about, lead to inflation. So that's why there's been so much focus on tapering. And 10 days ago, Fed Chairman Jerome Powell at the Fed's Jackson Hole Symposium intimated that the Fed would begin looking at tapering sometime this year. Many pundits think it'll be in the fourth quarter. Some think it could be as early as the third quarter. So that's basically what we saw. We saw the idea that the Fed is going to start reducing its balance sheet. We've had a lot of calls in Washington to reduce the balance sheet. All of this to stave off inflation. And then what did we get on Friday, September 3rd? We got an extremely weak jobs report. So a lot of momentum around tapering and reducing the Fed's balance sheet. And then all of a sudden on September 3rd, we had the August jobs report come out. The Bureau of Labor Statistics reported that U.S. added non-farm payrolls of 235,000 in August. That was more than 500,000 off the consensus Wall Street projection of 750,000 new jobs. So that was quite a disappointing jobs number. The unemployment rate did come down to 5.2%. But if you look, even at 5.2% and another 235 jobs, we're still well below the lows that we saw pre-pandemic. So all of a sudden, this idea that we had a slow jobs market in August, most people think it's the Delta variant of the coronavirus and new lockdowns, new business closings, new unemployment. Basically we're kind of starting the cycle over. I don't think anybody thinks we're going to go back to where we were, but it looks like we're seeing some slowdown. Already now we're seeing many on Wall Street calling for weaker jobs numbers in September. And now we have pundits also saying that maybe the Fed shouldn't look to tapering. Maybe we need more quantitative easing. Maybe we need more government stimulus. Maybe we're not really out of the coronavirus pandemic yet. So, essentially we have kind of the tale of two halves of the year. First half of the year, we saw growth, good jobs numbers, good jobs numbers, good jobs numbers. August, we saw weak jobs numbers. September, the expectation is that we'll have weaker jobs numbers. I already saw that based on the August report, Goldman Sachs this morning brought down their full year growth rate for the U.S. economy, GDP, from 6% to 5.7%. That doesn't sound like a lot, but on a $22 trillion economy, that's a big number. Underscoring that, too, is the Atlanta Fed's GDP Now model. As of last week, the forecast is down to 3.7% for the third quarter. Again, a month ago, when we last did our video update, it was almost 9%. So Goldman Sachs thinks that the economy is slowing. The Atlanta Fed's models show it. Employment shows it. Kelly, the real question is, are we going to continue to see the Fed buying bonds? And are we going to see more stimulus out of Washington? Does this give President Biden, the opportunity to do PPP Part 3, 4, 5?
Potentially, yes. I think there's been more pushback in Washington for the size of the proposed stimulus package or the infrastructure package. There's starting to be some pressure there, and we're definitely in a unique, dynamic, big picture scenario. Cameron talked a lot. You talked a lot about the Fed reducing their, doing the taper, reducing their bond purchases, which we knew that would come someday, and in effect, we should see interest rates start to go up a little bit, which we started to see about midway through the month. Rates had gotten really low, which kind of juiced everything in July, rolling into August. Now we've seen rates reverse a little bit. And we're not talking about big numbers, but the 10-year Treasury got down to, I think, 1.15. Now we're above 1.3. So, okay, we're kind of back to where we were before things weakened again from an interest rate standpoint. And you had a good point. The economic numbers are definitely weakening, and I believe a lot of it is because of the increase in restrictions because of the Delta variant. Those are real. They're happening in different geographic locations. I don't think we've seen it so much around, in our area, in the Cleveland area, but it is happening on the East Coast, West Coast. And the other, so you have, okay, the economy's slowing down a little bit. I don't think it's a long-term trend. The question is just how strong will we get coming out of COVID? My mindset has always been we're kind of back on track to where we were in 19, where we probably were in a mature economy. Things were going to start slowing down eventually anyways. COVID kind of changed that time frame a little bit. We still have a lot of room to go before we get to where we were or to get back on track. Economy-wise, there are parts of the economy that are back to 2019 levels, but other areas are not. And now we have this dynamic where unemployment's employment's slowed down a little bit. We're still making gains, but it seems like we've hit a little bit of a plateau, and I think that's kind of what we're seeing is this plateau, whether it's August, September, October. That's what's happening on that front. But the other side of it is there's still a lot of money out there, just money that came into the economy through the stimulus that needs a place to go. And you have supply constraints on a lot of goods and services, a lot of goods that we buy. It's hard to get stuff. We're waiting on stuff just for our office move. Hey, it's not here yet because of supply constraints. That's a reality, and it's hard to say when that's going to lighten up or loosen up. It will loosen up at some point, but that still means consumers are still sitting on a lot of money in their bank accounts, checking accounts, savings accounts. You don't get any interest. That money tends to flow into the stock market, which keeps the stock market going up, even though we may be in more normal times that we'd probably be seeing more weakness. I would have thought we'd see more weakness in August, but anytime we see any kind of a couple percent pullback, money comes in and we keep chugging right along, which I don't see that dynamic really changing over the next several months, unless there were to be a major change or something, kind of a wrench thrown into the gears that would be a shock to the system. But the reality is that liquidity dynamic will still be out there regardless of what happens, and we'll still be in the situation where there is not a lot of alternatives.
Stocks are the best assets to own,
right?
If you want growth.
And like Cam said, the low interest rates, that's good for businesses. You can borrow more. Obviously, the government can borrow more. Consumers can borrow more, but consumers really don't need to because they have a lot of cash. But one of the results of low interest rates, it's negative for the savers because obviously you can't get interest anywhere without taking on a decent amount of risk. But the other side of it is all this money that needs to be placed is going towards equities, but there also becomes a overallocation of capital to maybe not so profitable or not such good business ideas, and what forms are different bubbles in different parts of the economy. Things that look like, hey, these are great investments, invisible sculptures, things like that people are buying and selling online. If things were tighter and there wasn't so much free cash around, could you get $50,000 for an invisible sculpture? I don't think so, really? But call me crazy. Maybe times have changed. So,
well, could you also get 15 offers for your house, full asking price, all cash, the day you put your house on the market?
Probably not.
Yeah.
Unless it's a really great house.
Unless it's a really great house or undervalued.
Or there's an invisible pool in the back. You never know. So there's some different things going on in the economy. The reality is we're seeing inflation. Inflation's happening. There's parts of the market that are at prices that don't make sense. People are investing in businesses that don't necessarily make economic sense. Some of these things are going to get weeded out here at some point in time, and it really brings us back to, hey, how are we investing for it? And it comes down to know what you own. We want to buy good, solid businesses, not be vulnerable to what we think is going to happen in the future, or what is happening. Not get killed by inflation, not get killed by rising interest rates, and that's kind of how we have to deal with this. We're not going to be able to avoid, the economy is going to feel some kind of contraction at some point in time. It's just getting through it with the least amount of damage and not being in those areas that are going to get crushed, where wealth is definitely going to be destroyed. So, switching to what happened for our portfolios during the month, it was a good month for the stock market. The Dow Jones in August was up 1.5%. The S&P 500 up 2.9%. Yeah, we kind of thought that could we just see another, August, same as July type scenario. Going to September, we could see the same thing. But typically September gets a little rougher, so we can't count on that. Year to date, the Dow's up 15%. The S&P is up 20.41. That's been a little change in leadership over the last couple months. Before, the S&P was lagging the Dow. We've seen that switch a little bit, and the switch kind of happened as the Delta started firing up, so it was a little kind of that stay at home or things that worked during COVID. Traders have kind of gone back to those types of investments. I would argue that's probably a little more short-lived, so we're kind of sticking with what we're doing. From a portfolio standpoint, great month for growth with income. We're up 2.1%. Year to date, up 11.25. Our equity exposure in there is probably in the 55 to 60% range. Big gainers, NVIDIA, 14.9%. That's huge. Nucor up 13%. Microchip Technology up 10.28. Cisco Systems up 6.59. Big losers for the month, Visa, which had been doing well for us, down 6.8. Starbucks down 2.8. Murray, our emerging markets fund, down 2.88%. Emerging markets have definitely struggled this year, that's for sure. For the winners for the year, Nucor up 123%. Nucor stock is up 123. We're only up 25% since we added it. NVIDIA is up huge. That's up 72% for the year. Lennar up 42% for the year. Cisco Systems up 35%. Our biggest losers, gold, we're down 4.8, which we have both gold and broad-based commodities. Commodities have done well this year. Gold has lagged. We still aren't changing our stance on that. Verizon down 3%. And once again, Murray down 5% for the month, but down 2.88% for the month, and year to date we're down 2.14. Dividend yield, which has been kind of our best performing portfolio. August up 3.05%, year to date up 22%. So once again, conservative quality balance sheets is definitely working. Blackstone for the month up 9%, Pfizer up 7.62. So Booster shots sounds like good business to
Time
me.
your booster shot.
Eaton Corporation up 7, Prudential up 6.75. Losers during the month: McDonald's retreated 1.6%, Verizon down 1.4%, Coca-Cola down 1.26%. Year to date, Blackstone still leading the charge, up 99%, Eaton up 42%, Prudential up 41%, Waste Management 32%. Year to date, Merck lagging, down 5%, Verizon down 3.27%. Price potential, which is more of a growth-oriented portfolio, but he called growth at a more reasonable price. August only up 1.5%. Year to date up 18.5%, so kind of better than the Dow, not quite as strong as the S&P. Big gainers in August: Chubb up 9%, Microsoft 6.15%, Facebook up 6.48%. Big laggards during the month: Centene down 8.21%, Dollar Tree down 9%, Amgen down 5.92%. Year-to-date gainers that we're still sitting on in the portfolio. So we have more turnover in that portfolio, so sometimes we're realizing gains. So this is just what's left in the portfolio year-to-date. SPIG, S&P Group up 35%, Edwards Life Science up 28%, Allstate up 25%. The laggards, actually, year-to-date, we really don't hold anything. Dollar Tree's the only thing down that we still hold year to date. That's down 16%. Fleet Core down 3.5%. In our small cap portfolio, a little bit of a bump here. Small caps have lagged last several months. Actually, we picked up 3.3% in August. Year to date, we're up just under 20%, 19.75%. So we've kind of regained ground in there. Here's some big numbers. Gainers in August: the Joint Corporation up 30%, Profession up 26%. Veritas Partners up 13%, CSW up 12%. Laggards: One Water Marine down 14%, CareDx down 13%, Acme United down 4%. Year to date, our big gainers that we're still sitting on: Proficient up 150%, Atcor up 26%, LGI Homes, it's been a nice complement to Lennar, up 51%, Vertus up 46%, Nova Measuring up 43%, and our big year to date down: Pros Holding down 14%, Eventbrite down 2%. So SMID kind of showing some signs of life. So in general, what we're doing is, it's working. We're not stretching to get any, we're not getting too aggressive in our stock picks. Just kind of taking what's there. Keep it simple is the philosophy that we're going to stick with as we go through, really a different type economic scenario that I think we see more of the same over the next couple months.
If you have any questions, as always, please feel free to give us a call. Have a great month, and we'll talk to you next month.